Now we're going to talk about banks, which is everybody's most exciting concept. So, what do banks do? What is their monetary role? Well, for that, you have to remember that only a portion of M1 is actual currency, dollars and cents. It's only a small portion. The rest is actually demand deposits. So that's the money in banks, in checkable accounts. So the role of banks is to essentially handle those demand deposits and find out what to do with them in a productive way. So, what do? They take those liquid assets to finance investment in illiquid assets. So, they take your money, your checking deposits, your savings deposits, and they use it and loan it out to allow people to purchase things like homes, factories, cars, things that they wouldn't be able to afford without a loan. Now, they keep some of it on reserve at the bank. Now, what you see here are old bank reserve um, ratios. So, at the time I originally put this together, if a bank held um, less than $14.5 million in all of its systems, then they didn't have a minimum reserve. If they were between 14.5 million and 103.6 million, they'd hold 3%. Anything above that, they had to hold 10%. Now, once again, this is checkable deposits. They had to hold 10%. Now, these are outdated numbers at this point. Actually, at the time I'm making this video, there are no reserve requirements left on the banks. That might change in the future, but for now, there is no reserve requirement. That doesn't mean banks don't have reserves. Of course, they're going to keep some reserves because people need to come and get their money out on demand. That's the whole point. So, just because there's no reserve ratio doesn't mean that there's no money at the bank. You will be presented with T accounts, which you see an example here. Basic assets and liabilities ledger, summarizing your financial position. You have loans and reserves under your assets, and you have deposits under your liabilities. We'll do some more work with T accounts a little bit later on in the next video. But for now, just know what it is. The reserve ratio, in order to find it, you just find the reserves divided by the deposits. So if you look at the reserves on the asset side, $100,000 divided by the deposits, $1 million on the liability side, that gets you your reserve ratio. Now, since deposits are greater than reserves, if everybody runs to the bank at the same time to get their money, the bank can't pay them. And that ends with big trouble. That's what we call a bank run. Now, when this happens, banks go out of business, which means everybody who wasn't able to get their money, they lose. They're never able to get their money. Now, this is one of the primary reasons for regulating banks and why we have deposit insurance today. So let's take a look at some of our bank regulation. Deposit insurance is the one I just mentioned. The FDIC guarantees the first $250,000 of each account. So you really shouldn't be keeping more than $250,000 in an account. Frankly, if you're keeping that much in an account at a bank, it's wasteful anyway. You should be putting it into the stock market or some other investment opportunity to earn higher interest anyway. Capital requirements, that's essentially the idea that banks have to hold a certain amount of assets greater than their liabilities so that if the loans go bad and things of that nature, they can sell off other assets in order to cover their liabilities. Reserve requirements, as I said, for the event and run, the checkable bank deposits was 10% at the time I made this this presentation originally. Right now it's at 0, but that is possible to change. The discount window is the last bit of bank regulation. This is the way the Fed lends money to banks when they're in trouble. So if a bank finds itself in need of some cash in a short-term basis because they can't pay back their depositors, they'll borrow some money from the Fed. All of this leads into oversight of the commercial banks. Now, we are looking at commercial banks here, not investment banks. Those are going to operate under slightly different rules. Now, beyond all of that, how do banks create money? Because that's another role, well, a byproduct role, I guess I would say, of banks. The way to think of this is as this table points out. So here we have Silas keeps cash under his bed. And when you're looking at that, the currency in circulation right there is $1,000, and there's nothing in checkable bank deposits. So your money supply is effectively $1,000 that Silas keeps under his bed. He then takes that cash and deposits it in a bank, which then lends out 90% of it to Mary, who pays it to Annie Acme. So you think at this point, who has access to the money? The currency in circulation, the amount of dollars out there right now that Annie Acme has is 900. But Silas still has access to his checkable deposits of $1,000. So those are both considered M1 money. So both people have access to that money. Therefore, the money supply is $1,900. But that's not where it ends. Annie Acme then deposits that $900 in a bank, which lends it out to another borrower, which lends out 90% of it to another borrower. So $810 is the money in circulation to that new borrower. Annie Acme still has access to her $900. Silas still has access to his $1,000. So all of that added together gets you $2,710. And you can see a multiplier effect at work here, because eventually that $810 is going to end up at the hands of somebody else, who then eventually puts it in a checkable deposit, and then 90% of that is lent out. And then it keeps going on down the line until the multiplier effect is played out. Now some definitions. Excess reserves. This is the amount of money that banks can lend out. So it's your total reserves minus your required reserves. So if the bank has $10,000 in its vault, but it's only required to hold $1,000 in required reserves, then $9,000 is what it has in excess. It's important to note the money expansion does not occur until the money is lent out. So when Silas deposited his money in that bank, there was no increase in the money supply at that moment. The money supply remained $1,000. Once 90% of it was lent out, that's when we had an increase in the money supply, because now there's currency in circulation and checkable deposits. That's a question that the AP test loves to put out there and loves to try to trick students with. So make sure you watch for that. The reserve ratio is often shortened to RR. The money multiplier, so this is how much that multiplying effect that I just discussed on the last slide plays out, is 1 divided by the reserve ratio. So in order to find out your loan expansion, it's your excess reserves multiplied by your money multiplier. Or if you want to simplify the equation, it's your excess reserves divided by your reserve ratio. That's it. So if you want to find out how much the money supply expanded, it's that equation, excess reserves divided by reserve ratio, or excess reserves multiplied by the multiplier. So in reality, what does this look like? Well, first of all, this is a way of looking at the monetary base versus bank reserves. So your monetary base is the sum of your currency in circulation and reserves in your bank. So since that's set by the Fed, remember that. The bank reserves are not a part of the money supply. So the parts that they can't lend out, the full bank reserves, and they can't lend those out. Checkable deposits are not a part of the monetary base. So this is all some part that you have to remember. Your monetary base is your bank reserves and your currency. Your money supply is your currency and your checkable deposits. So the overlap there is your currency in circulation, and your money multiplier is the ratio of your money supply, or checkable bank deposits and currency in circulation, to your monetary base, which is your bank reserves and your currency in circulation. Now, in reality, our money multiplier is usually pretty low. At the time I put this together, it was around 1.9-ish, but it varies depending on how people demand money, how much people decide to hold on to money, what their liquidity preferences are, and things of that nature. And that's it for the role of banks. We're now going to look at how the Fed interacts with the money supply and what the role of the Fed is.